Good day, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and watching the Market Chameleon webinar series. Before we get started, let's take a look at the shared disclaimer. Please be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for professional advice, please reach out to a licensed representative. This webinar, as all our webinars and shows, are for informational purposes only concerning Market Chameleon tools and products. With that, one last look at the disclaimer, and let's welcome Dimitri Pargamonic to the stage to talk about charting out-of-the-money put premiums. This is a daily Market Chameleon webinar series. How you doing, D?
Good morning, Will. How are you?
Good. Let me bring your screen up.
Good morning,
there you go,
everyone. And I'm going to first navigate to our example, and then we'll talk about how to chart an out-of-the-money put premium. And the idea there is to get a sense, are the out-of-the-money puts in a particular stock on the high end or low end of their historical range? Where are they valued? So let's use SPY in our example. I'm going to type in SPY. We're going to navigate to the SPY main page. And over here on the left-hand side, we're going to click on, volatility. And then under volatility, let's click on risk premium. Okay, so then we'll come to this page here. I'm going to click on the menu to minimize it and expand our screen. And here we are defaulted to a chart. And you can see here that the chart settings are, we actually have two different parameters here. One is a constant maturity, which is a time frame. So when we look at charting an option value, we want to standardize it to a certain maturity, because the premium for example, a 10-day option will be different than the premium for a 20-day or 30-day or 50-day option, because you have more time, you have more time value. So what we want to do is first establish a constant days to maturity. So this gives us the available time frames, 30 days, 60 day, 90 day, or 120. And using that days to maturity, we use a weighted average methodology to look at the option chains and create a 30-day constant maturity, similar to like what the VIX does. And then the next thing we want to do is say, well, what option are we referencing? Okay, so here you have different selections. If we click on it, you could see we could have an at the money put, or we could have an out of the money put. Well, when we talk about out of the money put, we need to define how far away are we referencing. And when we do that, we also have to kind of create some kind of standard distance away. You know, we can't really do it in dollar terms, because if we do it in dollar terms, the stock moves around. So, you know, if we say $5 out of the money, well, you know, it's $5 out of the money when a stock is 100 is different than $5 out of the money when the stock is 657, or if the stock is $10, right? Because if it's $10, $5 out of the money is 50% away. If it's $100, it's 5% away. So we want to do that. We want to define, well, how far away in percentage terms are we from that the money? So in this case, we have the following selections. We have 1% below the at the monies, 2%, 5%, 10%, 20%. So for us in this example, we're looking for an out of the money put, and we have these choices here, and let's just say we select 5%. And what we're doing now is we're going to chart a 30-day constant maturity option with 5% out of the money. Okay, so I'm going to click on this, and now we get this chart. So when we get this chart, how is it charting that value? Okay, like how do we quantify the value of this option? And you can't really do it in dollar terms either, because a dollar option, again, it's relative. If you're paying $1 for a put in a $657 stock is different than $1 for a put for a $10 stock. So we need to kind of normalize it to say, okay, if we have $1, what is that in relationship to the stock price? Okay, how much premium are we paying based on what the stock price is? Right. So if you're paying $1 for a put in a $10 stock, well, you're paying 10% premium relative to the stock price. But if you're paying $1 for an out of the money put, 5% weight, if you're paying $1 for an out of the money put, $100 stock, well, you're only paying 1% of the stock price. So it's a big difference, right? If you're paying $1 for 10 to protect yourself in a $10 stock versus $1 in a $100 stock. So we have to take that premium and convert it to a percentage value, okay, percentage value of the stock price. So you could see here that currently, I'm going to hover over this, the 5% out of the money put would cost you 0.2% premium, 0.2% of spot price. Okay, and if we wanted to compare that to history, well, we could look at the chart and could see that just eyeballing it, it's been much higher, than that up here, and it's maybe been lower as well. But this dotted line over here helps us kind of measure it based on the average of all the values. So you see where this dotted orange line is, that's the average of all the values, which is 0.3%. So we're below the historical average value in the last 1 year. Okay, so it's looking at 1 year's of data, and now we know we're below. And another thing that this graph allows us to kind of visualize is the variability of the costs. So we could see it's not the put premium, the insurance to protect yourself to the downside after a 5% move down varies. It's not always constant. It's not like and thing is, like, when you buy insurance for a car, it's not always exactly the same. It's going to move around different factors. So we see here that it moves around. The chart kind of gives us a visual how much variance there is. So we could kind of see, moves around, I don't know, between 0.2, it's got as high as almost 2% at one point. But it does move around, and this dotted line lets us know how far away from the average it moves around. And historically, not only how far away, but how much does it sit around the average versus, like, something like this where we get this big outlier up here, or maybe something happened the premiums went way up, then came back down to their average. So this is a quick way to chart the cost of an out-of-the-money put, get an idea of where we're sitting currently at relative to its historical range, and how much the value of that put moved around its average, just to get a sense of the volatility. And here we could, because of the way we did it, we could compare it to other products, using these same kind of standardized metrics. Well, so I'm going to stop there and throw it back to you.
Great job, D, as always. Bringing these webinars to the Chameleons is super helpful to everyone. This was another great one. Thank you for doing this. It is Friday, so we won't see everyone until Monday. Great job, buddy.
All right. Thanks, everyone. Have a great weekend and a great trading day.
All right. You have a great day, my friend. We'll talk to you on Monday. Bye. Hey, everyone. Thanks for joining the Market Chameleon community and the webinar series. If you are here for the first time, remember to like and follow us on all the social platforms. If you're on YouTube, thumbs up, greatly appreciated. For those here for the first time, make sure you check out the free trial on the upper right-hand corner. You get a 7-day free trial. So just click on that. For everyone else who is already on the market, a loyal member and a member of the community, everyone have a great trading day, great weekend, and we will see you on Monday. Thanks and peace. Bye.